When you retire, one of the biggest concerns that we oftentimes see is healthcare, especially if you are retiring before the age of 65. So people are trying to figure out, well, what is the best case scenario? We've got a client scenario that I'm going to show you. It's a sample, but I want to really break this down and explain to you because we have a lot of clients who are set up a lot like this. But we first have to understand, well, what qualifies for the healthcare scenarios? Because you could get COBRA through your employer, which is oftentimes quite expensive. But then now we have Affordable Care Act, Obamacare, whatever you want to call this thing. It's the opportunity for you to get cheaper healthcare out there. And so we had a client who asked us specifically on a video. They said, hey, what about the Roth and using the Roth to keep your income low? So I'm going to address that as well. And I'm going to show you a couple different scenarios with this. But first, let's just look at the federal poverty guidelines here. So 2023, it shows those lines. That's for actual 2024 numbers, according to goodrx.com. And so if we're looking and breaking this down, a household with one person in there, 100% of the federal poverty level, $14,580 is their income. And so this means that potentially they would qualify for Medicaid. Now, every state is a little bit different if you're looking at what the qualifications are for Medicaid. And now there's some different things that have come into play where Medicaid and ACA are actually coming together in certain states and what they're doing. So every state is going to be state specific. Make sure you're aware of that. But if we're looking here, 138% of the poverty level, 20,120, 400% of the poverty level, 58,320. And so with ACA and the Affordable Care, what they're looking at is keeping your income below that 400% mark. And so if it's 400% or 4 times the federal poverty level. So if it's one person, 58,320, that continues to go up. As you can see, if you have a family of 5 and you're all, on the tax return, you have 3 dependents and you're married filing jointly, you have the family of 5 there. Well, that's 140,560 is the income you can make and potentially still get some sort of premium credit, tax credit on your tax return for the healthcare. The way this is going to work is you're going to be paying for the healthcare throughout the year. Well, at the end of the year, if you end up paying too much, then they're actually going to give you more of a credit back. Or if you paid too little, you're going to have to pay money back to the government for that. And so that's just a quick breakdown on how that's going to work. But let's go ahead and take a look here at Retired Roger, and let me show you and kind of break this down on potentially how you could keep your healthcare costs extremely low if you're retiring before the age of 65, some strategies that we're working on with clients. It's not going to be set up for everybody, but this person right here, Retired Roger, has a net worth of 1.4 million. And before you just jump out on this video because of that high net worth, if you're a lower net worth, what you want to look at is the breakdowns here, because he has $625,000 in a pre-tax account in a 401k. He has $200,000 in a brokerage taxable account with $125,000 cost basis. So he's going to have some gains, which is going to show some income when he sells off and he's using that money. And then he has $175,000 in the Roth IRA. And if we break it all down, yes, he's on track for retirement. Everything is looking great for him. He's retired at 55. He's investing, in a 60-40 allocation. But what we really want to start to look at here is the cash flows. And we want to say, okay, what is going to happen? What is this going to look like? And how can we make sure that we keep the income low enough? We actually have a client who is taking distributions from their 401k. They've left their money in their 401k, part of it there, because they retired with a rule of 55. They're taking some distributions to stay over the Medicaid line, but also still to qualify for as much as they can of the Affordable Care Act tax credits. So that's an option for you and kind of what I'm wanting to show you here on how we look at this and really break this down. And so for Retired Roger, what he's going to do is he's going to be withdrawing $48,000 from his taxable account. Well, again, he's paid taxes on this, but it's grown, so he's going to have some income there, but not a significant amount. He's going to continue to do that until age 60. But eventually at age 60, his account is empty. So then he has to say, okay, well, I'm going to take from the pre-tax account. Well, as you can see here, he's still, it's 61,000 potentially, in 2030, that's a few years from now. Maybe they're going to adjust this federal poverty line because right now it's 58,320. But if we're looking at this 61,000, he might be able to get some credits there. He may not. He may have to pay more for healthcare. And so the question is it worth going that route, or is it worth saying, hey, you know what? I have some Roth IRA money. Let me start to pull from the Roth account. Well, let's take a look and actually look at the breakdowns here. Now, I'm not going into the details on how much healthcare will cost if you go with this side of things, because the reason for that is every healthcare plan is a bit different. Even on the Affordable Care or the health marketplace, it's going to be different depending on what you pick there. But if we're looking at this breakdown right here, we know that he would have to pay quite a bit more in healthcare, at least until age 65, if he goes this route. But if he goes this route, then we've got to say, okay, well, let's look at how this is going to affect the plan versus if we went over and we said, you know what, he's going to do a different strategy here, and he's actually going to take money from, I'm going to adjust this for you and show you exactly. So let's just say that he's going to take money from instead of the taxable, tax deferred, let's see, there we go. Taxable, tax deferred, tax free, taxable, tax free, tax deferred. If we compare these two, just apples to apples on the withdrawal strategy, we're looking right this second. At the end of the plan, you would have $208,000 more of adjusted dollars. The question is, just right there, is it worth it for you to change strategies to not pay any healthcare costs from 60 to 65, but at the end of the plan, you're going to have $208,000 less if you go the route of taking from the tax-free account second after you've spent down the taxable account? And so if we're looking at this and we really start to break this down even further, we can look and see actually the allocations here. And I really want to show you actually the tax liability that they're going to be looking at as well with this if we were to go with that plan. And so I go over here to the distribution strategy and I'm going to run this. And we can see that on the distribution strategy, what the breakdown is actually 86%, 87%, $2,137,000 and $2,163,000. Well, to me, that's not a big difference at all. When you're talking over $2 million, $30,000 difference is kind of pocket change when it comes to the end of plan. I mean, we're trying to predict out 35 years of life here. And so what we really want to look at is the cash flows. And we say, all right, make sure that we've got this accounted for properly. And we've met this client's goal of what they were asking for. And that's spending down taxable accounts first. And then you go to the Roth IRA and look there. At 65, the Roth IRA is now all spent down. You're going to start pulling from the IRA. And at that point, Medicare is going to step in and you're going to have that. And you're going to avoid all of those extra healthcare costs that are potentially, causing this massive fear for you in retirement. But again, I want to say, is that worth it? And so if I really broke this down, we have the strategy here that I'd showed you a minute ago and how it's $208,000 more of tax adjusted dollars. But that's at the end of the plan. Some people say, well, I'm not worried about the end of the plan and what that looks like with everything. And so we're instead looking at saying, okay, well, how much more tax are you actually going to pay? So let's actually break this down even farther. And I know I'm getting pretty geeky with this one, but if you're breaking this down even farther, you're saying, okay, if I do the taxable and then the Roth and then the tax deferred accounts versus if I do the taxable, then the tax deferred, and then the tax-free accounts or the Roth. And so I did the calculations for you just to give you an idea based on Nest Egg, the software we use with clients. And just to show you this, you're actually going to pay taxable, tax deferred, tax-free, $273,000 in estimated taxes over your life. But if you do taxable, tax-free, then tax deferred, that's $436,000, a significant amount more that you would actually have to pay out of your pocket to Uncle Sam just to save a little bit on healthcare. So is it worth it to you for 5 years to pay more in healthcare? Or is it worth it to you to say, hey, you know what? I'm going to just keep it the way it is, or I'm going to go this route and I'm actually going to just have to pay more in taxes. I want you to let me know in the comments what your thoughts are, because if you look at plans, apples to apples, really you're going to be able to be successful through your retirement no matter what. But one plan is going to pay more tax over time, and one plan is also going to have less tax adjusted dollars if you have beneficiaries.